where there is the entry into the trend. Fantastic. It stays in the trend right until it stops trending over there. Then it re-enters the trend and gets out of the trend over there. Same thing over here. It enters the trend nice and early and exits nice at the point where the market starts going sideways. So fantastic indicator. Let's go and see what it's all about. So in this video, I'm going to explain how the MACD, and that is the indicator we're going to be talking about, works and why it produces the best trend entry and exit signals. I'm going to show you some initial automated MACD trading robot results, and I'm going to show you how you can access the automated set and forget MACD trading robot. And then lastly, I'm going to show you a few of my own secrets that simplifies the MACD trading considerably. Now, just at the bottom of the slide here, we say the MACD stands for Moving Average Convergence and Divergence Indicator. And that's MACD. That's where the MACD gets its name from. So what is convergence and divergence? Let's go and have a look at that. Okay, so let's have a look at the settings for the MACD. The MACD works with a fast EMA and a slow EMA. So those are the two components that it works with, and then it has a signal line, which I'll explain a little bit later. But essentially, the drivers are these fast and slow moving averages. And let's go and have a look. On my screen here, I have the two moving averages. In fact, the ones that are shown here, the red one is the 4 moving average, and the blue one is the 13 moving average. And there you can see them on the screen. And as you can see, the signals produced by the MACD have produced fantastic results. And we're going to have a look at a lot more than this. But I just want you to understand how the MACD is created. So what the MACD measures is the distance between the fast moving average and the slow moving average. And that distance can diverge or it can converge. And that's where the secret lies. So what happens is, let's take the situation where both of them are at the same place. So on the next candle, what happens is there's a gap between them, between the fast moving average and the slow moving average, and that is what the MACD measures. So these bars on the MACD measure the distance between the slow moving average and the fast moving average. And how does it do that? Firstly, it takes the slow moving average, that blue line that you see there, and it makes it flat. It flattens it. So the blue line actually becomes this middle line that you see on the MACD. So it flattens it. And then the distance between the red and the blue line becomes the bar that's down here. Because it's actually very difficult to see this with the eye on the chart. So it actually creates bars for you. So there's the bar. So the next one is bigger because that's moving away and that's getting... So the bars get bigger and bigger and bigger and bigger and bigger. And then suddenly they stop what we call diverging. So when the bars are getting bigger, it is diverging. The moving averages are diverging from each other. When it starts getting smaller, they start converging on each other. So over there, you can see the gap starts getting smaller, 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 and then eventually they meet. So the MACD measures the divergence and convergence of the moving averages when it's going up and when it's going down. That's all it does. Firstly, let me tell you a story. I went into a trading room about 20 years ago, a financial institution that was trading, and there were about 20 traders on the floor.